Welcome back to Economic Outlook. As you are well aware, global markets continue to face unprecedented levels of uncertainty. However, one product has shown considerable appreciation since the financial crisis began in 2007. Of course, I'm talking about gold. Prices for gold have increased by 51% since the beginning of the financial crisis. Today, I want to examine why the price of gold has increased so much, and also look at whether or not gold prices can be expected to continue their remarkable bull run. Gold's gains come from a unique mix of circumstances. Recent events in the European Union, along with record deficits in the United States, have shaken faith in traditional fiat currencies. Investors have sought safety in gold. They hope that gold will protect them against inflation, currency depreciation, and potential bank failures. The popularity of gold can largely be traced to the deficiencies of traditional fiat currencies. A fiat currency is the familiar paper money issued by a government, and the currency only has value by fiat, or the order of the government that issues the money. The money can't be converted into anything of value. So, for example, the US dollar is a fiat currency. In 1971, the United States abandoned the gold standard, and dollars can no longer be exchanged for a specified amount of gold. The currency became fiat because its value is derived only from government decree. This lack of convertibility is common to many of the world's major currencies, and since 1971, no major reserve currency can be exchanged for gold or any other commodity of value. Fiat currencies offer both benefits and drawbacks. Lending, credit, and liquidity are more easily expanded with fiat currencies. However, the dangers of inflation, bank stability, and public confidence are also more acute. The financial crisis of 2007 demonstrated several of the deficiencies of fiat currencies and the allure of gold as a protection against these problems. These issues can be grouped into three general categories. First, let's look at the potential for bank failure and the safety of assets. The first problem with fiat currencies is bank stability and asset protection. When Lehman Brothers collapsed at the end of 2008, the United States faced the specter of bank runs. Customers wondered if their deposits were safe and if they would be protected if a bank collapsed. Customers sought safety in gold. Because gold is very portable, it's easy to store. And in addition, gold has a very dense value, meaning you can store a lot of value using only a small amount of gold. And this made gold a very attractive alternative to banks, which customers lacked confidence in. For example, assume a small local bank faces a bank run. It's very likely that the bank could run out of paper money deposits before it could reimburse all of its customers. However, if a customer has gold in storage in either a safe deposit box or the bank vault, it would be protected even if the bank ran out of paper fiat money. The risk of bank failures was reduced by the G7's requirement for increased deposits. Additionally, by early 2009, TARP, stress tests, and other means restored some level of public confidence in the banking sector. However, all of these programs contributed to another major issue with fiat currencies, that is, the ease of depreciation. The second major problem with fiat currencies is depreciation and a loss of value. Because these currencies cannot be converted into anything of value, they can quickly depreciate. Their value is only derived from government law and public perception. If the public believes that a fiat currency is worthless, there's really little that can be done to change this perception. The financial crisis has destabilized currencies and shaken public perception. Gold has become a popular hedge against the depreciation of many different currencies. Consider the case of a German who is concerned about the value of the euro. This person might be worried that the euro will depreciate relative to the dollar or other major currencies, and she has several options. First, she could take her euros and simply purchase another reserve currency like the United States dollar. She could then invest these dollars in some kind of interest-bearing security or account. And this would help mitigate the risk of depreciation of the euro relative to the dollar. But what happens if this person is concerned about the value of all fiat currencies, or specifically certain popular reserve currencies? then gold becomes a popular option to hedge this risk. This investor might choose to purchase gold to hedge against potential depreciation of all reserve currencies. And this works because gold is a relatively scarce commodity. Most of the gold that's mined each year is used for jewelry, electronics, and other products. However, gold is not really a consumption commodity like oil or copper. So the supply of gold remains relatively stable from year to year, meaning that it can hold its value because supply doesn't increase dramatically. Now, when currencies like the euro or the US dollar begin to depreciate, the value of gold is seen as a good hedge because the supply is stable. Therefore, the value of gold will rise as these currencies depreciate. Fiat currencies have no such supply stability. Governments are free to print as much of a currency as they want. Because of the massive bailouts and record federal budget deficits in the United States and elsewhere in Europe and many countries throughout the world, public confidence in fiat currencies has been shaken and the monetary supply has grown exponentially. Now, in good economic conditions, this isn't as large of a problem because public confidence will increase as the monetary supply expands, and you don't have this issue of sort of a confidence problem with the fiat currencies. There may be fundamental issues going on, but public confidence remains high because times are good. However, when we have economic catastrophe like we've had over the past 3 years, public confidence sinks. And when public confidence in fiat currencies declines, the value and importance of other commodities like gold increases. And this is why investors turn to gold as a protection against the depreciation of fiat currencies. Now, this expanding monetary supply leads to another important part of the problem with fiat currencies, which is inflation. In my next entry, we'll examine the issue of inflation in more detail. I'll also look at some of the counter-arguments which say that gold may be nearing the end of its bull market run. We'll examine both sides of the issue here on Economic Outlook. Thanks as always, and be sure to visit my website at www.econoutlook.com. I'll see you next time to conclude this entry. Thanks as always.